the capital gains tax changes introduced by the budget were unexpected but very welcome. The annual exemption remains at £11,100, but the rates of capital gains tax have tumbled. The 28% rate applicable to non-basic rate taxpayers, that is higher rate and additional rate taxpayers, has fallen from 28% to 20%. And the rate payable by basic rate taxpayers has fallen from 18% to 10%. So quite material, these changes. These changes have no impact for business owners in practice looking to sell their business, so in relation to any gains they make from the business, because they're entitled in most cases to entrepreneurs relief, which delivers a 10% rate. But for investors, they are really significant, and something else to consider along with the dividend tax changes and the introduction of the personal savings allowance. They have a really beneficial effect, quite obviously, on investors in unwrapped collectives. We're talking about collective investments outside of an ISA or a pension arrangement. For these arrangements, they will deliver dividends, interest and capital growth. So for the capital growth part, we have a significant reduction in the rate of tax payable, if tax is payable, of course, because the annual exemption is, of course, still with us. So is there ever a case that you can make for an investment bond in relation to the capital gains tax? Unlikely. The bond has tax deferment qualities. For a UK bond, then undoubtedly there is a favourable position inside the UK bond because only real gains are subject to tax. So gains after applying indexation at the rate of the retail prices index, not the CPI. However, that will still mean any gains over and above that will be subject to tax, and the tax will be reserved for inside the fund at a rate probably somewhere between 10 and 20%. 20% is the highest it can be on the real gains after RPI relief. So that's quite attractive. However, unless that rate is below the rate that the individual will suffer on an unwrapped collective, then for a basic rate taxpayer, even for a basic rate taxpayer, it can make no sense to invest through a UK bond in relation to the capital gain. Of course, there are other aspects to take into account when considering investment, but in relation to the capital gain, you might secure a slightly lower rate inside the bond, but it's unlikely unless indexation is quite high and the effective rate is lower than 10%. Because even though you suffer no tax when you cash the bond in, if you're still a basic or non-taxpayer, the internal rate is quite likely to be greater than 10%. So how about additional and higher rate taxpayers? Well, for them, inside the UK bond, you get the benefit of indexation, you get the benefit of a lower than 20% rate, but when you realise the gain after tax being reserved for inside the fund, you're going to have a tax rate of 20 or 25%. So at least as much for a higher rate taxpayer as the rate that they pay, and materially above it for an additional rate taxpayer. And of course the fund will have also borne tax, so it can't really make sense. For an offshore bond, of course, there's no tax at fund level, so that looks good. That is obviously better than 10% or 20%. However, when you realise the gain, if you're a UK taxpayer and tax is payable, then of course you're going to be suffering income tax on those gains. Even for a basic rate taxpayer, that's going to be at 20%. That's significantly more, double 10%. And for an additional rate taxpayer, it's 45%. And for a higher rate taxpayer, it's 40%. So very, very difficult to make the case for holding capital gains producing investments in relation to the capital gain inside a bond.